Well, good afternoon, everybody, and welcome to Everyday Funding's Webinar Wednesday. Today is Wednesday, August 29th, 2018. I am Patricia Bauer, your loan officer, and I'm joined today by Michael Mulholland, COO of Everyday Funding.
Hi, everybody. Happy to be here.
Thanks for joining us. Our topic today is what to expect after signing your contract. Financing is the most important part of any deal. Too many times we see investors go into contract without their financing in place. Don't wait until there are only 2 weeks left in your contract to try to find your financing. If you're using a private money lender, make sure they are ready, willing, and able to close by the date on your contract. If you're using hard money lenders or long-term financing, things can delay us, like your appraisal or your title work, and you don't want to be left scrambling at the last minute asking for an extension on your contract, possibly even losing your deposit. So get that application in right away.
And just to talk about what Patricia was saying, even if you're using a private money lender, we had a situation where 2 weeks before they were going to close, the private money lender said, listen, my daughter's getting married. I knew about it, but she wants to have a Venetian hour, et cetera, et cetera. It's costing me more money than I thought. I can't lend you the money. And that was a mad scramble. So just be aware that financing has to be done very quickly. And the quicker you start, the better off you are. Even if you're, a week earlier than closing date, it's better than being a week late.
Right, and you can always call us at Everyday Funding Services to get pre-qualified so you know exactly how much you can qualify for your mortgage.
So the next slide we want to talk about is simply the numbers, and we'll come up right in a minute. So hopefully you've done this already, but the reason I'm going over this is all financing is going to come down to really the numbers. So for purposes of this webinar and an example, let's just assume your after repair value, that's basically what you can sell it for after you fix it up, it's going to be $300,000. The hard money lender will lend you 65% of the after repair value. That's the lesser of two. It's either 65% of that or if the money comes under. In this example, they will lend you up to $195,000. Okay? However, let's just assume you purchased this property for $100,000. You're going to need to put $20,000 down. Okay? They're going to lend you $80,000. Let's just assume you're going to fix the house for $50,000, and you submitted to them a very detailed scope of work. They'll lend you up to 100%. Notice I didn't say they'd lend you all of the money, and a lot of that has to do with the detailed scope of work. Okay? And finally, closing costs. The $10,000 in closing costs, you have to come up with yourself. Example of some closing cost items would be the appraisal, the financing, possibly points, taxes, insurance, attorney's fees for both you and the bank. This is not just limited to these things, there are other. So your total all-in is $160,000. So let me just summarize. The hard money lender will give you $150,000. How do we come up with that? 80% of the purchase plus 100% of the repairs. You need 20% of the purchase, that's $20,000, plus closing costs of $10,000, plus carrying costs. You're going to have to pay for insurance, electricity, snow removal, grass cutting, etc. Right? That's $8,000. You're going to have to pay the hard money lender interest, and I'm assuming that you're going to do it over a 6-month period at approximately $1,500. So basically, altogether, you need $47,000 worth of money to skin in the game. Patricia?
So, Mike, if 65% of the ARV is $195,000, you're saying I can't get $195,000?
Well, that's where I said it's the lesser of the two. So you come up to that and you show him that you bought it for this, your scope of work is this, he's going to lend you $150,000, he won't give you the $195,000.
Okay, thanks for clearing that up.
So next, and this is before we get into this, one of the things we need to emphasize is caveat emptor, let the buyer beware. Although you're dealing with professionals, attorneys, appraisers, title companies, etc., if somebody along the line makes a mistake, you're going to suffer the consequences. Okay? This is an education for you to understand your due diligence. Many times people use they use attorneys that are excellent lawyers, but they just happen to be excellent divorce lawyers. And they say, oh yeah, I'll do it at a discount. Sometimes that discount is, they mean well, but you lose money. You can look on our website, LIREIA, under resources, and get the attorneys who deal with basically investors. They're not just real estate, but they're enhanced real estate attorneys.
And these are investors that we ourselves use,
yeah.
So we can recommend them based on our own experience.
Step 1, have your attorney order a title report. Okay? The purpose of the title is so you can get marketable title. It means the chain of title is clear and free from defects. It can be marketed for sale. So in a title report, they look for certificate of occupancy, open building permits and violations, liens, mortgages, mechanics liens, tax liens, personal debt. We're closing on a house. We actually just closed on a house this Friday, 311 Yale, and our title report unearthed that there was a issue with the electrical that dated back to 1992. The people we're buying it from, they bought it in 1993, yet their title report never discovered it. We now are having a big issue, and they had to come down $10,000 in their price, and we have to get a updated certificate and an electrician to come in to fix it. And that's the classic why you need to have a really good title. Okay.
Another part of your title is going to include a survey.
It won't include a survey.
Well, you'll have a survey ordered, and what you need to do is have that survey read into the title report. We'll talk to you in a few minutes about our Happy Acres story.
Which isn't so happy. Okay.
So the next thing you have to do is understand that there are two different title insurance policies. There's the owner's insurance policy and the lender's insurance policy. And yes, you have to pay for both of them. The owner's policy covers the owner for his investment in the property, which is your down payment. It does not, however, cover any improvements, rehab, that you've already done to the property. The lender's insurance covers the mortgage holder to the full amount of the mortgage. If you purchase a house for $300,000 and you put down $100,000, and 5 years later there's an issue with the title, the owner will receive $100,000 and the lender will receive $200,000. In addition to that, the lender will have to reimburse you, the mortgagee, any principal payments that have already been made. So your insurance is extremely important in having the right policy.
Yep. So getting the right title done and having the right title insurance is worth its weight in gold. It's very rare to have a title issue, but on the rare circumstances, that's when you need to do. Okay. Next, we have, and this is critical for mortgage financing. And me and Patricia are going to go into this. So, as you probably already know, dealing with hard money lenders, you really need to have this in a corporation. They will not lend you that personally, and you also personally don't want this because you want to have this in a corporation. There are two kinds, S Corp or a LLC. I'll talk about the S Corp, Patricia will talk about the LLC. The S Corp, they're very similar, but they're going to want you to have articles of incorporation, EIN, that's like a social security number for a corporation, a filing receipt, the bylaws, and a certificate of good standing. I just want to point out that in New York State, you can only receive it by fax or U.S. Postal, no email. Cost is $25, can take 7 to 10 days. Certificate can't be, has to be not greater than 30 days. And the reason for that is that you may not be in good standing. Now, what is not in good standing? You didn't pay your taxes, you didn't file your taxes, or you did something illegal. and that's just unique to New York State. I suggest that if you're having it sent by mail, you pay an expediting fee. Finally, there's a corporate resolution. Keep in mind that corporations are considered people in the eyes of the law. So probably yourself, who's a manager of the corporation, is agreeing through a resolution that this corporation is willing to borrow money or take on debt. Okay?
So the LLC is very similar. You'll have your articles of organization, again, your filing receipt, your EIN, which is your employee's identification number, the operating agreement, and the same certificate of good standing. And again, to purchase a property, you may have to come up with a company resolution just stating that any members of the LLC all agree to taking on this debt, this mortgage expense. In addition, your lender will expect you to pay for the appraisal, possibly an inspection and a background check. So you want to make sure you have all of your corporate documents ready and available, that you can turn them over as soon as possible to get your mortgage going.
And many of those documents will be in a binder or folder that you get at the time when you actually establish the corporation. Okay? Surveys. Well, we've alluded to surveys, and this is where we're going to tell you the story of Happy Acres. Okay? This happened 12 years ago. I emphasize 12 years because it's still going on today. Okay? So basically, we had somebody purchase a house. It was actually Melissa, and she purchased a house on a block called Happy Acres. The address was 18 Happy Acres. So she had an attorney, and he wasn't a real estate attorney, but he was relatively inexpensive, and he asked her, do you want to have a survey done, or do you want me to just take the existing survey and have it updated? She says, well, what's the difference? Oh, it's in money. If you have a regular survey done, it's going to cost you $1,500, but have it updated, it's going to cost you $600. She says, great, have it updated. Bought the house, and she then proceeded to renovate it and tried to sell it. When she tried to sell it, the other people had to serve, the buyers had a real survey done, and they found out 18 inches of the house was on somebody else's property. Won't go into how this happened, but basically it's a long story, not for this webinar. But she had clear title, but she didn't have marketable title. Why? Because the property was on somebody else. So effectively, she couldn't sell it. It was foreclosed on, but it couldn't be foreclosed on either. As a matter of fact, there's a lawsuits are still going on even today, and nobody's even sure who owns this property because it can't be sold. Okay? So let me just go through what a survey does. And remember, make sure you have a survey and pay the extra money. This way you won't have an issue. Survey shows where the boundary lines of the lot are. Okay? You have to have that read into the title report so there's no issue. It also has a FEMA flood map zone. The property falls into a flood zone. Sometimes floods don't happen for years, but it's good to know. Survey is the only tool that knows that you're really buying in terms of land. Okay? We talked about the Happy Acre story, which certainly did not end happily, and it's highly recommended that you get this. A survey, in addition, helps you sell the property. Okay? Because if you're a rehabber, you have a survey, you can go to the seller and say, look, I'm saving you on this, and it's just been done recently. There's no change to the boundary lines in the last 6 months. And make sure, again, to have your attorney read this into the title report.
Okay, so Mike, when do we order a survey?
So this is interesting. What we do here, and everybody's up to them, we always order the survey after the title comes in. The reason we do that is because if the title report comes in and finds out there's no clear title, why should we spend $1,500 to have a survey? They're usually very quick to do and take a week. Okay,
so it makes sense to get your title work done first, make sure you have clear and marketable title, and then order your survey, since it doesn't take much time to get the survey completed. And what about water and sewer?
Okay, so there are parts of the country, and I just wanted everybody to be aware of these things, okay, where water and sewer is very expensive. specifically New York City. It can be thousands of dollars. In addition, there are things that you don't always see, and that may not come up on the title search. So, for example, if the prior owner were evicted or tenants were evicted and they dump all their possessions on the street, they have 1 week to clean it up. If they don't get it cleaned up, the town removes it, and that cost is added on. It could be added on to your taxes, could be a separate fee. But if you close, this becomes your problem. Another example is the grass is a foot high. The town will come in and they'll cut the grass. They're going to charge somebody for it. If you're the seller, should be the one paying it. But if he doesn't, you're going to be the one. Another classic here, especially on Long Island, is buried oil tanks. One time, there was buried oil tanks everywhere. That was normal. They didn't put them inside the house because they want to save space. And after a while, they leaked. Now these oil tanks required abatements of $2,500 to $3,000, and you need a filing fee of $800. Another classic is vacant land. Patricia and I had an attorney, and he told us a horror story where somebody refused to get a environmental study, and they found a historic unknown cemetery on the land. Right. If they had gotten that, they would have been out. Another classic is gas stations. There are some banks, especially I believe it's FHA in New York State, they have to be 600 feet away from a gas station. So you might not even be aware, but take a look at Google Maps to make sure that your backyard isn't touching a gas station. And finally, we have co-ops and condos. They have dues. Make sure that those dues are up to date and all paid for, homeowners association, etc. Because once you close, you'll be stuck with those.
Right, and just going back to the buried oil tank, if you become aware that there is an oil tank that has been abated on the property, ask the seller if they have an oil tank abatement certificate.
Right. Yes, that's critical. The oil tank abatement certificate proves that it's been abated properly.
If not, and it has not been abated properly, this is another cost that you can incur, and it can run anywhere from $2,500 to $3,000, and then there's even a filing fee, which is another $800. So the fees will just keep adding up and up for you. It's really good to look for these things ahead of time. Next is our insurance. So we all know insurance is critical, and you really only have to get it a few days before the closing. You don't have to get it the day your contract has been signed. Do not assume that a standard homeowner's policy will suffice. It will not. Properties that are vacant for more than 30 days are not covered. So if you have a flood or a fire, if there's vandalism done to the property, and you only have a standard homeowner's policy, you will not be covered. So what do you need to cover yourself for this, Mike?
Yeah, you need a builder's risk policy. And as a matter of fact, your lender is going to insist on this. When I first started flipping houses, I, took out, State Farm policy. Somebody came along and said, hey, if you have a fire, they're not going to cover you after 30 days. And said, oh, how would they know? Well, listen, when they're paying out $200,000 to rebuild a house, they're going to come down and they're going to send an investigator. It doesn't take, Columbo to figure out that nobody's living there. There's going to be tools, no beds, etc. The builder's risk policy is just that. They know it's vacant and they're charging you. Now, we recommend NREI, National Real Estate Insurance Group. Okay? The reason we recommend them is because they were started by investors, real estate investors. And they're right on our website. You can find them under resources, and you can take advantage of a specific discount we have.
So if they go through our Long Island RIA website, they get a discount?
Yep, they get a discount. You don't even have to be a member, so long as you just go through the Long Island RIA website.
And use that link that's on the resource center.
Yeah, use the link on the resource center. Okay. The reason we want to do this is many times non-REIA will ask you to pay 1 year up front. So if the policy is $2,000, you pay 1 year up front. I'm just making the numbers up. I don't know whether it's 2 or not. What will happen is if you finish the rehab in 7 months, you're going to not get a rebate. If you use an REIA, they charge you monthly so that your premiums won't be done. The other thing that's critical, and this actually happened to me and Patricia, is somebody didn't want to pay the policy until they closed. Well, in reality, the policy is just a couple of dollars a day, and they kept postponing because they weren't going to start paying extra insurance. It came down to a grand total of $12, the 3 extra days, and the closing ended up getting postponed, all because they wouldn't pay an additional $12. Insurance really isn't that expensive.
Right. What happens is people will ask me all the time, when do I want my start date? That's when the insurance starts to be covered. I don't know when I'm closing, but you want this policy now, and so when should it start? Oh, okay, I'll have it starting the last day that I have to close according to the contract. Well, if we're ready to close before that, and we're always trying to close you as quickly as possible, now we cannot close until that insurance takes effect on that start date. So paying a couple of extra days, yes, it's just a few dollars extra out of your pocket, but it'll enable you to close when we're ready. So remember, if you go on our LIREIA.com on our website, click on the Resource Center, and you'll see a link for REI Guard, which is the insurance company that we recommend. We use them. I use them. We have them on the property that we own together, Mike.
Yep, we use them all the time, and we'll tell you a great story about them at the end. So again, just to summarize why they're good or why you need these builder's risk, they pay by the month. The policy covers unoccupied, and you can actually, the policy is, I'll call it graduated. So you buy the house, it needs repairs, it's unoccupied. Well, there you're going to pay the highest premium. You finish the house, you have it on the market, you can actually get your premium lower because by the time you sell it and somebody moves in, 2 or 3 months may go down and you get your premium. Now, if you find out that, you know what, this house is great, it is great cash flow, I can rent it for a lot of money, you can now take this house, this insurance policy, and convert it into a occupied and for a lower premium. They're very competitive.
Right. Not all insurance companies do that. So once again, we recommend REI Guard, and you can find them under our Resource Center.
And we don't get anywhere. We're not getting the kickback from REI Guard. We just use them ourselves, and we wanted to recommend them. And we wanted to give a final word about REI Guard. So we had a property, I believe it was in Pittsburgh, and there was a fire. Thank God nobody was hurt, but the property basically burned down. REI Guard was the insurance. They came in within a week, paid in full, as well as we had insurance that insured the rents. So got 6 months worth of rent. Everything went great. An interesting thing came up. Our property manager had recommended, and he actually wrote in the lease, and he made them sign the clause that we have on this presentation in red, and he actually had it in red. And it said, we recommend that you have renter's insurance. Okay, renter's insurance can be $10 to $15 per month. If you choose not to get said renter's insurance, the landlord will not be held liable for fires, floods, and damages not covered by their insurance. Okay, they made them initial it and sign it. After the place burnt down, sure enough, we were sued for by one of the tenants.
And what happened with that?
What happened was this clause, the lease, was presented to the judge. They had signed it and was thrown out of court. Now, we all felt sorry for the lady because she didn't have any furniture. So all of us kicked in a couple of $100 each, and we were able to buy her some beds and some furniture. But the idea is that they need to have this, and courts may rule against you.
Right. So not only having the right insurance, but also having the right clause in your lease is very important. So copy, write down what you see there in red. Very important clause to put in if you don't already have it in any of the properties that you're renting out. So I would like to thank you for joining us at Everyday Funding. I'm Patricia Bauer.
Mike Mulholland. And if you want, send us an email on topics you'd like to hear from us. We'll be back in 2 weeks. Thanks, everybody.
Have a great day.